All right, welcome to tonight's webinar. It's October 17th, 2018. We're going to be talking about shorting the market. We've had lots of opportunities to short the market over the last couple of days. As we had last week, just a couple of days ago, the market had one of its worst days in about 6 months. And so we had plenty of opportunity to short the markets. And I want to make sure that everyone is ready to pull that trigger when the time comes. And even if you don't want to pull the trigger, even if you don't want to be a short, even if you have no clue what shorting means, this is especially good for you if that's the case, you need to have a good understanding of how the short side of the market works. So let's go ahead and get started here. I'm excited for this webinar. I've been waiting to give this one for a while. So first of all, let's talk about what is shorting and then how do we actually go about shorting. Okay, there's a lot of different ways that we can go about shorting. It's much more complex than you think. There's different products made, volatility products that you actually are long on, but you're technically short the market on because the product reflects the short side of the market. It can be complex, so we'll break that all down, try to simplify it for you, and of course, we'll give a nice definition and show you guys how you actually do short a stock. So first of all, what is shorting? Well, the whole idea behind shorting is that you make money when a stock goes down. Okay, so contrary to being long on a stock means you make money when a stock goes up. And it's kind of confusing because people think, oh, I'm long on a stock. That might mean that you're long term. You want to hold that stock long term. That's not the case. Being long on a stock just means the direction you're anticipating the stock to go. Same thing with shorting. Okay, if you're short a stock, you expect the price to go down. If you're long a stock, you expect the price to go up. So when you're buying and going long on a stock, you typically will buy first and then sell at a higher price to make money. Well, when you're shorting a stock, it's the exact opposite. You sell first at a higher price and then buy it back at a lower price. And I'm going to break that down a little bit and hopefully clear that up a little bit. So here's my example. It's October. It's MLB playoffs. Got to use a baseball example, right? So let's just say you have a friend that owns an Alex Rodriguez rookie card back when he was in Seattle. Okay. Now, of course, Alex Rodriguez ended up being an amazing player, and that card has some value to it. Well, you have a friend that owns that card, and for whatever reason, you think the value of that baseball card is going to decrease. Okay. Who knows why? That's just your theory. That's what you believe. So what you do is you go ahead and you ask your friend if you can borrow his Alex Rodriguez baseball card. Now, your friend says, okay, sure, but you have to return it to me in a certain amount of time. Okay. I'm going to go back in a second and explain how this more directly ties to brokers and stocks because they give you, time limits on borrowing and things like that. But to get back to our example, your friend says, sure, here's my card. I don't know what you want to use it for. This means a lot to me. Don't lose it necessarily. I'm going to want it back in 3 months. Make sure you give it back to me in 3 months. Okay. You say, all right, no problem. So you take his baseball card, you take it down, you take it to Vegas. I don't know. You take it to some shop, you take it wherever, and you sell that baseball card for market value of $100. All right. Boom. $100 in your pocket. Seems great. Seems like a good deal, right? You just cashed in $100. Well, it's not quite that good of a deal because you still have to get that baseball card back and give it to your friend later, right? So anyways, a couple months go by. You have this theory and idea that something's happening in the baseball card market that's going to decrease the value of this Alex Rodriguez baseball card. So a couple months go by and your friend says, hey, I'd like my baseball card back like we agreed. So you go back to that same store and you say, all right, I would like to buy that Alex Rodriguez card there on the shelf. And you ask, okay, what's it going for? And the owner of the baseball card store or whoever it is says, oh, it's going for $90 right now. You say, great, I'll buy it for $90. So you pull out dollars out of your pocket and you buy that baseball card back. All right. And then the result is you go back home, you return the card to your friend, and I don't know, maybe you got his permission first to do it, maybe you didn't. But the point is, you're gonna kick him a little fee, for his trouble. So you say, all right, here's $1 for lending me your baseball card. Okay, I know it's kind of a cheesy example, but hopefully it can illustrate what happens. So what just happened in that story? Well, first of all, you made $100 cash when you sold your friend's baseball card. Okay, $100 cash right in your pocket. Well, 3 months later, you went back to the store and you bought it back for $90. Congratulations, you were right. The value of that card did decrease. Who knows? Maybe you got an inside something with the baseball card market, but you were right. Your short thesis was right. The value of the card decreased, so you only had to buy it back for $90. Well, that leaves you $10 of profit left in your pocket. So then when you take your card back to your friend, typically in a situation like this, and with stocks, when you're shorting a stock, you have to pay a small borrower's fee. In this case, you paid your friend $1 for the trouble. And so total, you made $9 off of shorting the baseball card. Okay. So let's take this exact same example. That's how shorting works. Let's take this exact same example and be a little more specific with stocks. So let me go back in time here. Let's say you believe that Netflix will drop in value. All right. So you go to your broker, not your friend this time. You go to your stockbroker and you say, hey, I believe Netflix is going to drop in value. I need to borrow some shares. I don't own any Netflix shares. I need to borrow some shares from you. You're a broker. You got plenty of shares, I'm sure, that you own. Can I borrow some for you? They say yes. Now, nowadays in shorting, obviously, you don't actually have to call. It used to be that way back in the day. Every trade was made. If you want to make a trade, you had to call someone to do it. You had to call to see if they're shorts. But the point is, you have to call them and say, hey, do you have any shares of Netflix that I can borrow so that I can go sell them on the market in anticipation that they will drop in value and I will then buy them back later? So in this case, if TD Ameritrade or E-Trade, whoever your broker is, if they have the shares, they'll say, sure, I'll lend you these shares to you, but they have to be back at a certain time. And I'm not going to get into the details about the time frame of how long you can hold a short. Each broker is different. There's certain regulations depending on how much money, are you on margin, et cetera, et cetera. We could write a whole book about that. So we won't get into too complicated details about that. But the point is there will be a time restriction and you will want to return those shares back to your broker shortly. Okay. Well, you take those shares just like you took that baseball card and you take those shares and you take them to the market and you sell them at market value and you receive, your account gets debited, a lot of money because you went and sold those Netflix shares. All right. Well, time goes on. Maybe it's 5 minutes, maybe it's 10 minutes, maybe it's 3 months, maybe it's 6 months, however long you want to hold your short position. And you have to go back and you then have to buy your shares back off of the market. Now, if you were right, if Netflix shares decreased in value, well, you just made money. However, if Netflix shares went up in value, you have to buy those shares back at a higher price that you sold them for, and you actually lose money on the short. So that kind of is how it relates. So let's get a little more even specific here, and let me show you some shorts that I made over the last 24 hours. Okay, a lot of trades. I know it's messy. This might look a little complicated, but I want to summarize here. This is Netflix. Netflix released earnings yesterday. Look at the big spike on the far left of the screen. You guys see this big green candle right here? Well, the stock ran from 300 and about, I think it was 338, all the way up to $405. Okay, it did that in about 2 minutes after they released earnings yesterday. Well, when that happened, as soon as I saw that spike, I looked at the numbers. I thought, no way, that makes no sense. This stock should not have spiked that much. So what did I do? Well, I called up my broker, not really because it's all automated now. And I said, give me some Netflix shares. I want to borrow them so that I can sell them on the market. And that's what I did. I sold shares. My first sell was actually at 394 something. But these are 5-minute candles, so it bunches my sells together. But anyways, and I shorted this stock and I shorted it. And then I would buy it back after it drops a couple dollars. Then what happened? I'd short it again. And I'd buy it back after it drops a couple dollars. I'd short it again. I did this 4 times yesterday and after hours, all for profits. Okay. I'd short 100 shares here, 50 shares here, and the stock would move $5, $6. Well, if you have 100 shares short and the stock drops $6, then you buy it back $6 lower, you just made $600 or so. Okay. And my shorting continued. Look at this. This is this morning. Okay. I know, again, it's kind of hard to read, but I shorted the heck out of this thing. I actually also did go long on it twice, but I didn't lose one trade today. I mean, we're looking at 12, 13, 14 trades here. The majority of these were short. I think probably 11 of these were short trades, and then 4 or 5 of them, I think 4 trades or so, were to the long side. But I won all of them. I was very happy with it. Okay, so this is a real life example of how we short. Let me show you a little zoomed up picture. This was, again, this green candle here is right after Netflix dropped earnings, okay, and had that huge spike, huge run up that I felt just made no sense. You'll see I sold here at 390, 360, and just like a couple minutes later, I bought it back. Again, these prices and stuff are a little weird because if they're in the same candle, it takes your average price and whatever, it's kind of a mess. But you get the point. Hopefully you get the general point here, okay? So that is one way to short a stock. You just simply borrow shares from your broker, you take them to the market, and you sell them, and then you buy them back later. Now, when you buy your shares back later, they automatically get returned to your broker. You don't have to do anything to borrow your shares or return the shares. It happens automatically as long as your broker has shares to short. All right, so let's talk about some other ways that we can actually short the market. Okay, I want to talk about the VIX. Okay, VIX. Now, no one really had heard of the VIX until February. This most recent February, VIX was kind of like, I don't know, I don't want to say it was secretive, but it kind of was secretive. Like no one traded the VIX really until this last February. You'll remember February 5th of 2018, we had what we call the flash crash. The stock markets dropped, I don't know, what was it, 1,100 points. Dow Jones dropped 1,100 points or something. It was crazy. Just these massive drops in the markets. And all of a sudden, this thing called the VIX started getting tons of news attention, tons of media. So what the heck is the VIX? Well, for starters, this is a product that was created to gauge fear in the market so that when the stock market goes down, the VIX goes up. Now, it's a very complicated algorithm. And you could get into the details. I'm sure you could research more exactly what moves the VIX. But basically what moves the VIX is these algorithms that try to account for fear in the markets. So when people are panic selling, the VIX is going to go up. Now, there is something interesting about the VIX, and that's this. It naturally loses, the VIX and its products lose value over time. And I'm going to explain that a little bit more in a second. But a little trick about the VIX, and this is actually really interesting, okay? Look at this bottom right point here. Hedge funds have made easy money for years being short the VIX, and I'll explain that here in a second. But basically what happens is the VIX, because it naturally loses value over time, or I should say the products of the VIX naturally loses product over time, all you had to do was short the VIX. And 2 years later, you would have made huge money. And this is what I mean by that. So the VIX has two main products that I watch. There's actually probably, 20, 25 products of the VIX that all move in different ways depending on what the VIX is doing. But UVXY and TVIX are the ones that I like to watch the closest. All right. Now, these are leveraged ETNs that move off the VIX. So if the VIX moves up 10 cents, we could see a 50-cent pop in the TVIX or UVXY. And it's because they're leveraged. Again, it's a little complicated, the details of how that all works, but basically small moves in the VIX lead to big moves from UVXY and TVIX. Now, this is what I mean by it was easy money for hedge funds and why hedge funds got in a lot of trouble back in February. This is why. This chart here is TVIX. You see this huge fall? This is over 3 years. 3 years ago, okay? If you would have bought one share of TVIX 3 years ago, let's say you bought $33,950 worth of this stock, well, today it'd be worth $37. Now, why is that the case? It's because this product, TVIX, it's designed to naturally decrease in value over time. So it just naturally decreases in time. Even if the stock market is going completely sideways, not up or down. Let's say it went sideways for 2 straight years. Okay, that would never happen, but let's just pretend it did. Well, the TVIX would still lose value. So what they do here is they schedule reverse splits. I don't remember the details. It's either every 6 months or every year. But this stock, it's not really a stock. This will automatically reverse split over every 6 months or over every year. Okay, now CQB just asked a great question. He says SVXY naturally increases value. So SVXY is the opposite of TVIX. Okay, they both move off of the VIX. So we have the VIX, which is like the parent master algorithm of them all. And then there's about 20 different products that run around. Okay, TVIX is a bearish ETN that moves with the VIX. SVXY is a bullish product that moves with the VIX. So SVXY is more representative of the overall markets. Now, to answer CQB's question, no, it doesn't. Even though SVXY goes up when the market goes up, it still loses value over time. That's just how ETNs and ETFs work naturally. That's just how they're designed. That's why I don't like leveraged ETFs. Even if it's a gold ETF, if it's an ETF that follows marijuana, if it's an ETF that follows financial leaders in the S&P 500, whatever it is, ETFs, they just naturally decay. Okay, it's called natural decay. That's why I avoid ETFs. People ask me a lot, what do you think about these ETFs? And 9 out of 10 times I say I'm not at all interested in them because they just naturally will decay. Great question by CQB there. All ETNs will naturally decay. Now, TVIX here, as you see, if you were a hedge fund 3 years ago and you shorted TVIX, you're making a lot of money, right? So for a long time, and hedge funds still do it actually, you would just short these bearish products of TVIX and UVXY. Now the issue is, well, back in February, the stock market nearly crashed and hedge funds had to go out of business because they had huge amounts of money short the TVIX. And as we all know, these products, the markets crashed, so these products ran, 200-300%. Well, imagine having a $10 million short position in TVIX. The markets crash, all of a sudden you're down 30 million on a position, right? Your clients are calling, what the heck is going on? I just literally lost all of my money. And you're the hedge fund saying, don't worry, it'll come back later. It'll come back later. Just be patient. But they don't care. Your clients don't care. They don't, they're trying to get out, and you have margin calls, et cetera, et cetera. So that's why this all got so much media attention there. So keeping in mind that these naturally decay, let's talk about TVIX a little more closely, because I actually traded TVIX today to the long side. I traded it twice, and I want to talk about how I traded it. My first trade this morning on TVIX, markets were spiking. They had an incredible pre-market. They were way, way, way up. And in my head, and after what I've seen in the last couple of days, I knew that spike and that run up from overall markets was just too much. And so I wanted to buy some TVIX, thinking that the markets would come down and TVIX would spike. Well, I was definitely right. I bought here at 36.46, ended up running to $40. Okay, so it could have been a $400 trade for me. I wussed out and sold for like $30 in profits. Okay, totally wussed out. But I was right. My theory was right that it would spike and markets would sell off at the beginning of market open. This gray line is pre-market. This dark represents actual market open. So I was right in theory. Okay. I didn't chase it, after this and things, and I was too busy shorting Netflix. Again, this upward spike from TVIX means the markets were falling heavily. Okay, but I want to talk about these. This is the trades I really want to talk about here. Okay, I shorted the market as what I call a hedge play. A hedge play, you've probably heard the term hedging your bets. Well, when someone hedges their bets, that means they're being a little bit safer. Okay, so let me explain here. About midday, I started getting a little bit bullish on the markets. Okay, thinking, okay, I think we could get a strong close here. So I started to go long Tesla. I was long Netflix. I was long WGO. I was long LCRX. I took 4 or 5 long positions. But I didn't like the idea that I was only in long positions. I wanted something to kind of hedge my bet. I wanted something that would increase in value just in case the stock market pulled back. So what did I do? I bought some TVIX. My first buy is here at 39.04, and I averaged at 38.16. Now you'll notice I was down pretty heavily on this. I was down, I don't know, $300-400 at one point on this trade. But I was fine with that because that means that my other long positions were moving to the upside. So this is a way that you can hedge your bet. Now you'll see later in the day I ended up selling, for close to break even. This, I don't know, I might have actually taken a small loss on this, but that wasn't the point. I didn't care. I wasn't really trying to profit off of this trade. I just wanted to be safe since I had so much long exposure to the market, meaning I had so many positions that I was betting would go up. I didn't like it. I thought, man, I'm over leveraged to the long side. I need to safeten up a little bit. Let me get a position that will go up if the market comes down. And that was this. And so this, I ended up getting out, near break even, maybe a small loss, $40-50 loss. I can't really remember. And then Netflix and all my longs took off in the end of day, and I made great money on them. Ended up being a $2,000 day for me of profits. So this explains here another way you can short the markets. If you want to get short on the market, if you think the market is going to fall, TVIX, UVXY, which are products of the VIX, okay, those are your bets. Those are what you want to look at there, okay? Now, you guys probably have quite a few questions, I imagine. I know it's a lot of information, so please go ahead and ask them, and we will get to them. Well, what I want to talk about first real quick, though, and I was mentioning this a little bit in the chat room the other day, I wanted to talk about what the front side of a trade is and the back side of a trade is, and why understanding this can really help you be patient as a trader and just help you understand how important entries are and how important exits are. So let's go ahead and talk about this a little bit more here. This is my Netflix trade. Now, I told you guys that this was when I started to go long on Netflix. This right here is the end of market right here, at 365 on the far right. Let me make sure you guys can see my mouse here. Let me pull out the laser pointer here. So this is where market closed here, okay? And right here, this is about midday. You can see this is 10:15. This is Mountain Time, okay? So that's like a little after noon Eastern Time. This is when I started to take bets on the market going up, and I ended up being right, and I ended up profiting really nicely off it. But I want to explain a little bit what the front side and the back side of a trade is. The front side is I will often talk about slowly scaling into a trade, okay? I was confident that markets would curl and move to the upside and to close, but of course, I don't have a crystal ball, okay? I have no way of knowing when it's going to do that. And I have no way of, excuse me, and I have no way of knowing, where the exact bottom is. Geez, you see this exact bottom? Man, find me the person that can guarantee 10 out of 10 times predict the exact penny that this exact bottom is. And I promise you, one, I promise you he doesn't exist. Two, I promise you if he did, you wouldn't know about him because he would be so rich and he'd be hiding his secrets. But the point is, you want to slowly scale into your ideas. Okay. Oh, I have a theory that the markets are going to reverse to the upside. Let me go ahead and start my front side. So you'll see I bought 100 shares of Netflix. That's 363. I bought another 50 shares at 361. Now, Netflix continued to pull back, and I was okay with that. It pulled back, all the way down to 356. I was down, I don't know, $500-600 at one point on this trade, more like $400 on this trade. But I was okay with that. Okay, I was okay with gauging that risk. Now, 356 was a critical level of support here, and so that was kind of the level I was watching. If it couldn't hold that level, then I'd look to exit. But I was okay with having this drawback, and then it went sideways forever. And then once we got this break at 362, I knew it was going to be a really strong close, and I was just waiting and sitting on these profits. And look at this sell. I sold my last shares at 366.74. The last spike was like 366 or 367.50. I mean, I almost sold at the exact top. Okay, that was kind of, I'll admit, there's a little luck involved in that. I mean, I didn't know I was going to be that. I didn't know that was the top. I was just locking in profits and selling into strength like I did. So this ended up being an awesome trade. I was in 150 shares. My average was like 362, I don't know, 362.15 or 362.30 or something. And I sold way up here in the mid 366s, for my average there. So just keep in mind, this is the front side. I slowly scale in. This is the back side where I slowly scale out. Okay. So you need to ask yourself, what is your thesis? Okay, this is my front side. What is my thesis that I'm trying to slowly scale into? What am I looking for? What am I trying to buy and take advantage of here? So hopefully that kind of gives a little bit of a visual representation. You always should have a front side plan and a back side plan. Your front side plan, I'm going to buy here, I'm going to average down here, or maybe you average up here, average down or average up. If it goes down to here, then I'm going to get stopped out. If not, then my backside is going to develop into my trade theory really well, and I'm going to profit from it. Let me answer this question from CQB here real quick. Is it a good idea to keep a long-term position in TVIX to hedge portfolios? No, I would much rather be in cash. Being in cash, and what I mean by cash is just having cash sitting in your account that's not in a position. That's actually a hedge within itself. And people don't understand that, It's actually the safest hedge you can have is just being all cash, right? Like you don't have to be long Amazon and short Netflix to be properly hedged. No, just sell, right? Just sell everything, be cash until you feel that you have an edge to play a market move to the upside or play a market move to the downside from a short position, right? Now today today I did hedge my position a little bit because I was really confident that I was going to get that midday market reversal like we did here on Netflix and I'd be able to profit off it. But I still wasn't willing to go all out. I still wanted to limit my risk a bit, especially with the Fed minutes came out today, and I wanted to be safe and careful with that as well. But that's a really good question, though. So no, I wouldn't always keep a position in TVIX to hedge my portfolio. That's definitely wouldn't do that. I'd rather just be all cash. Being all cash is just so safe and it's so comforting and so peaceful, and you'll sleep so well at night. If you sell all your positions and you go to sleep confident that you can wake up in the morning and just trade a fresh slate again, it's it's a game changer. It makes all the difference there. So that kind of covers there the front side and back side. Now, what I want to do next is I want to talk about how we actually execute a short. Let me pause this screen sharing here real quick. And I want to pull up my ThinkOrSwim and show you guys real quick. Sorry, give me just a second. It's taking me a second how to get out of this here. But yeah, I want to show you guys how we go about actually executing these trades. So let me pull up my active trader here. Okay, sweet. So I'm going to go live here again. Play this for you guys. Okay. So you should be able to see, this is my ThinkOrSwim platform here. You can see my profits on the day from Netflix, up $1,800 today just on Netflix alone. In total, I was up about $2,400 today or so. But just on these small little trades at Netflix, 100 shares here, 50 shares there, 100 shares there, 50 shares there, up $1,800. Really nice day. I'm super happy about those profits. So I'm just realizing you guys can't see my mouse, I don't think, which makes me feel dumb because I was using my mouse to point out stuff from earlier. But, well, I apologize. Hopefully you can see this laser. Anyways, you see my profits there over on the right. Profit loss day, 1837. Okay, so let's go ahead and talk about how you actually execute a short. If I want to short this stock, what the heck do I do? Obviously, if I buy a stock, I know what to do. I'm going to click right here, right? I'm going to go up here to the active trader. I'm going to put in, let's have some fun with it. I'm going to buy 10,000 shares of Netflix. Okay, I'm not. And that would be, what, 3 million or something? I don't know. And then to buy the stock, I simply click here in this area to buy the stock, okay? Well, if I'm shorting Netflix, it's so simple, guys. All we do is click on the red side. Do you see this red side here? That is where we click to short. Now, there's a lot of different options here. What I've been doing a lot recently is I've been trading for real quick $1 flips. I wouldn't quite call it channel trading because it's not really channel, but it's more of trend trading is what I call it. I call it trend trading. If a stock is trading in a pretty clean trend to the downside, I'll just buy it and flip it like I did here this morning on Netflix, and I'll just flip it for $1. And let me show you how I do that. I have a template set up. It's where I click on template. I'm going to click on target with bracket. Okay. Now, what I typically will do here, if I click right here at 362 and I get filled my 10,000 shares on this Netflix trade and I get short here, then I automatically will have a take profit cover as a buy $1 below where I'm shorting, okay? And if you don't want to have a stop in, if you want a little more room to be able to average into a position, all you do is uncheck this box. Now you only have a take profit and you don't have a stop loss, okay? Or if you want to let it run, but you want to have a stop loss, you do the opposite. You uncheck that one, you check this one, now I have a stop loss. And look, it's the same thing if I buy. Do you see how it switches? If I'm shorting, my stop loss is above, obviously, because I get stopped out. If I'm buying, my stop loss is below. I've got a question here. Let me answer this real quick. Gonzo says, click it. Well, markets are closed, so at this point, luckily, nothing would happen if I did try to short 10,000 shares. But yeah, no, I'm not quite up for that gamble here. Also, there's no way I have, 3 million. I don't have that in my brokerage, in my portfolio here to handle that size position anyways. But the point is, I like to use this because sometimes these Netflix trades, I will only be in for, honestly, 10 seconds. I'll short here, and it's so volatile that I'll cover $1 lower within seconds, okay? But hopefully that singles it up. We short by clicking here, and then remember you have to buy back your shares. So if I short 10,000 Netflix shares here, remember to buy them back, hopefully at a lower price. If I buy them back 10,000 shares at 361.50, then I click here to put in my buy order and cover and get out. If you're not sure what the heck is happening, you don't know if you're short or you're long or if you got out the right way, look at this, position flat. You see this says I have no open position in Netflix, position flat. You always want to have this up. That means I'm done. Or you can always click this flat button just to get the heck out. It'll take you to zero. That means you have no shares long or short. That's like an emergency thing. If you're just, I don't know what's happening. Shoot, I messed the order up. Get me out. You just hit the flatten button and you're safe. So that's how you actually execute a short. You just click here. One thing I want to talk about as well, see this button up here, ETB? Pull out my laser pointer again. Make sure you guys can see this. Okay, right here. See where it says ETB up here? This is where this stands for easy to borrow. Okay, so in this case, Netflix is easy to borrow. All right, now let's take a look at Yeko. Of course, I'm sure you guys remember Yeko. Yeko, I can guarantee, is going to be NTB. And I'll show you why. See that? There it is, NTB. See how this is NTB? That means none to borrow. Okay, that means if I go to, if just like I would go to my friend and ask to borrow his Alex Rodriguez baseball card, well, if I go to TD Ameritrade and say, can I borrow some shares to short? They're going to say, heck no. No way. We've already lent them out for people to short, or we just aren't interested in letting our customers short that stock. It's totally their choice. That's why a lot of people say, oh, TD Ameritrade is not good for shorts. It's true, but if you're shorting, mid cap and blue cap stocks like Netflix and things, then it's totally fine. So, okay, any questions for me, guys? Do you guys have any questions? That's all. That's the material I have prepared. Try to be short and succinct as usual. But do you guys have any questions for me? Please ask away. Any questions for me? Just remember, there's so many different ways to get short on a stock. Really, so many different ways. You can do the TVIX. You can directly short a stock. A lot of different options. Okay, so day trader Dan here is asking, what about trailing stops? Do you ever use those? Truth is, I rarely use trailing stops, and I actually don't know the last time I used a trailing stop. And here's my reason why. I like the idea of it, and I like the theory of it. But if I have the idea of a trailing stop, in my opinion, I would rather just get out now, take profits, because a trailing stop guarantees you that you will not sell at the high, right? If you sell into strength, you actually will get lucky every now and then and sell at high of day. Now, I know, of course, you make the argument, okay, yeah, but trailing stop, it could run another $5, and then my trailing stop follows at $4, and I made way more money. Yes, that's true. Like I said, I agree with the theory. I like the idea of guaranteeing yourself some profits, so that's great. Go ahead and do that. But I personally just don't really use that. Now, mentally, I have trailing stops all the time. I'll be in a stock. Okay, I'm up $1. I'm up $1.20. I'm up $1.30. Okay, I'm gonna watch this level. If it pulls back and I'm only up $1 again, I'll exit. Right. So mentally, I have trailing stops, but in terms of hard trailing stops, I don't tend to use them very often. I don't know. Maybe I should more than I do, but it's just kind of my thoughts there. Any other questions here from you guys? Chris, is there a difference in broker fees for shorting? Yes, that's a great question. Yes, there are. And they're quite minimal. If it's a stock like Netflix that's easy to borrow, they're quite minimal. If it's a stock that's maybe a little bit harder to borrow, sometimes it'll be more expensive. Again, you don't really have to worry about that with TD Ameritrade, because basically if they're not easy to borrow, then they're not going to have any to borrow anyways. If you're using a different broker, for example, TLRY, if you wanted to short TLRY, 2 weeks ago, you would have had to pay like 80%, some outrageous fee. If I wanted to short TLRY at $300, it would cost me like $220 a share just to get the borrow, meaning the stock would have to drop all the way down below $80 for me to even profit on the short, including my borrow fees. So yeah, they are slightly more expensive, but for a stock like Netflix, it's nothing to worry about. It's nothing to be concerned about. So yeah, that kind of sums that up. But that's a great question. That is a great question. Yeah, thanks, CQB. I appreciate it. Just giving a little rundown of shorting. I want everyone to just be aware of how it works and have those options when the time comes. You never know when you might, want to pull that trigger. Any other questions before we wrap things up here? Just short and succinct. Hopefully you guys enjoyed it, and can also, I did record this, so you guys can come back to this if you do have questions about how it works, about how the VIX works, what is the VIX, what is TVIX, what is UVXY, et cetera, et cetera. There's a lot of stuff there. Thank you, Steve. Appreciate it. All right, well, I'm going to hop off. That is the end of the webinar. 37 minutes, nice and succinct. I was hoping for 30 minutes, but I probably rambled too much, so I'll take the blame for that. All right, well, I'm excited to see you guys all tomorrow trading. really happy about how I traded today. Like I said, plus $2,200 day for me. Feeling really good. Hoping to end the week strong. 2 more trading days left, and so let's get at it tomorrow. Let's stay smart, stay conservative, let's stay safe, and let's get those profits. All right, I'm hopping off. Thank you guys for joining me.